Hey folks, Vic here with your weekly trade video. I recently updated my suggestions for trade management for our short-term trading members, and I'm sharing that exact video with everyone today in the hopes that it will at least give you some ideas on how to manage a trade once you're in it. I don't know how else to say this, but trust me when I tell you that this can completely turn your trading around. And to be even more direct, if you don't have a trade management plan, don't trade. Okay? It's just that important. Some of these ideas are mine, and others are from Darko, and they should combine to give you a very solid trade management plan. Okay? And although I talk about short-term trading in this video, it can be applied to any style of trading. It doesn't matter, right from scalping on up to position trading. So I hope you find it helpful. If so, please give it a thumbs up. I really appreciate that by hitting the like button, and be sure to subscribe to our channel by clicking the subscribe button in the lower right corner of the video. Thanks so much. I hope you get lots out of this video. Hey folks, this is going to be a video on trade management. I'm making this because of the tremendous importance that risk management and trade management plays in trading. Without a solid risk and trade management plan, you will very, very likely fail at this business. In fact, I've never seen anybody make it that doesn't have a good risk management plan in place. I'm going to be going over a trade here that's a scalp trade, but what I'm going to be showing you can be applied to any style of trading. Scalping, day trading, swing trading, position trading, doesn't matter. Okay, the principles are the same. So to start with, when I say risk management, there are two components to risk management. Okay, there's account risk and there's trade management. They're both about managing risk. For account risk, very simply, I would just say keep it small. Okay, you can still grow an account very, very nicely without risking a lot of your trading account. Okay, because what you risk is ultimately up to you, of course, but we recommend to keep it at no more than about 0.5% risk per trade. Okay, if you have a smaller account, say it's under $1,000 or so, and you're okay with risking a bit more to begin with, again, and this is up to you, I would definitely want to keep it at no more than 1%. And then as your account grows, I'd want to see that reduced to 0.5%. But that's going to be an individual thing, but I would not go above 1%. Capital preservation is everything. If you don't have capital, you're not trading anymore. I can tell you that the trading graveyard is full of traders who would give anything to go back in time and only risk 0.5% of their account instead of taking huge risks and wiping out their account. So, trade management. What I'm going to talk about are suggestions. Okay, do what you want, of course. Keep in mind, you do not want to be making a little bit when you win, and then losing a lot when you lose. That's a bad formula. So here are some ideas for looking after a trade. And I'll use this trade this is on the Aussie Swiss pair, just to illustrate. This is a set and forget. It's a swing break. We had a swing break here and a lower close than this low, and then we had a higher close than these highs, so it's a swing break rotation. That's not really too important. I just want to show you the trade management part. As price comes back down to this level, and you buy it in here. And by the way, by nature, just keep in mind this, because I'm showing you this on a 15-minute chart, scalping and short-term trading is going to be hands-on once you're in a trade. It's just the way short-term trading is, because you can be at 1-to-1 reward risk very quickly, like in minutes or sometimes even less. So once you're in a trade and you're up an amount equal to your initial risk, okay, when you get into that position, do something. Don't sit there. That something could be to simply move the stop to your entry so that you can't lose on the trade. You could then go for a bigger target, which could be an opposing level that gives you a good reward risk that makes sense, or it could be a Fibonacci extension, etc. The point is to have a plan ahead of time. So I'll show you. In this case here, we had this move. I like using these deeper retracements because they give you a really good reward risk. But if you bought it down into here, 79%, or even at the daily significant, that black horizontal line is daily significant neckline. Your target might be the extension from the low to the high. The extension was right here, which happens to be the next daily level up in this case. Okay, so here's what happened in this trade, and I'll just take this off for now. As price came down, and you buy it at around 67.11, the stop is actually, the volatility stop was actually below this natural stop. This is a really good situation. So you have this natural stop here. The volatility stop was just below it. So that's a really good situation. You got an 11 pip risk, right? So when price reacts like this and it goes up 11 pips, okay, or if you get a strong reaction after entering, how could you reduce or eliminate risk? Well, you can move the stop up from here to underneath here. Okay, that reduces risk right away, right? You can move the stop up, so if price comes against you, you're going to get a reduced loss. And the reason you move it up is because of this very strong reaction candle right here. Or here's another idea. You could take an 11 pip profit, okay, and then move the stop either to your entry here at 67.11, or still keep it just underneath this low rate here, because although you're still risking, say, 5 or 6 pips, even if you get stopped out there, you're going to be overall slightly profitable because you took an 11 pip risk to begin with, okay? And by not moving the stop up too quickly, you're still giving, like, say if you moved it right up to break even right away, you're still giving yourself a chance for price to wiggle around a bit. Sometimes it'll come down and retest this level and then take off, okay? Again, these are ideas. Or here's another one. Once you're up 11 pips, price gets up, don't scale out at all. And instead, just move your stop to your entry, up to where you get in, okay? And then, because you can then go for bigger profit targets with your entire position, unscaled, right? So the profit's going to be unscaled, and it makes it a much juicier situation. Listen, the differences in how traders do this gets down to your own comfort level. I want to be very clear in saying there is no right or wrong answer as to how you manage your trade. You don't have to answer to anybody but yourself. But again, make sure that the reward risk makes sense, okay? Don't go for tiny little profits because you're nervous and then take full losses when you're wrong, okay? And think about this. Once you have the risk right out of the trade, or at least reduced, that's a great position to be in. So make it your goal to not panic once you're in a trade, but instead to observe the price movement. Just be calm, see what it's doing, remove the risk when it's logical to do so, logical, not due to emotion, but due to logic and following your trade management plan. And look, listen, I've just touched on a few ways to manage a trade. There are lots of other ways. I just keep it very simple for now. Okay, if you want a suggestion for getting started, I would say take a profit on half your position when you're up 1-to-1. Okay, move your stop so that you can't lose on the trade. Right, so if you take an 11 pip profit here and you move your stop to either to your entry or to just below this, you can't lose on the trade. That'll help you. That's a great position to be in. That will help you to build confidence. Okay, and once you've been doing this for a while, you could then make whatever changes you prefer. But for sure, don't manage a trade one way one time, then another way the next time. Don't do that. Okay, be consistent. And then with more experience, yeah, sure, you may decide to tweak the way that you manage a trade. So there you go. I hope that was helpful. If you have any questions, just ask. Thanks. So we saw how we can manage a trade when it goes in our favor, and how to, reduce risk, take profit, and that kind of thing. Well, unfortunately, trading is not that way. We don't always get profitable moves. They move against us sometimes. And I'm going to show you an example. And again, this can be applied to any time frame, any style of trading. And this is a trade that set up. It was actually higher highs in price, and it was actually a MACD divergence trade. It's also a head and shoulders here. But in any event, it doesn't matter. I want to just show you what you can do. And I like to sell deeper retracements. So if you look at this move here, 79% is always nice because it gives you the reward risk is really good. So the sell was up here, and at 93.77, the volatility stop and the natural stop were both well above this high. It was up at 89 here, and that never got hit even when it went up this high. But I want you to focus on what happened after the trade was hit. The entry was here, but notice that it closed against your entry right here, and again here, and again here, and again here. This is not good, folks. That's not what you want to see. You got 1, 2, 3, 4 closes against you. Don't let that happen. If you get when you get several closes against you, and listen, this is a general rule. When you get more experience, there might be situations where you don't do this, but you want to keep things pretty mechanical, especially when you're getting going with this trading, and do it in a consistent, logical way every time, or you're going to run into trouble. So, you know, this, and you can always, listen, as you get more experience, you can always tweak your management a little bit, but it's got to be logical and based on, you know, your own observations, your own emotional makeup, that kind of thing. So you got all of these closes against you. Find a way to get out, if you can, get out at break even. Well, fortunately, this spiked back down and gave you a chance to get out for break even. So that's one. So that's one way of you know, getting out of a trade when it's not working, which is consecutive closes against you. 2 or more, yeah, you know what? You start looking for the exits on that as a general rule. Another thing is time. This is like the entries here. You got this, 2, 3, 4. This is like getting onto an hour in this trade. It's not going anywhere. I don't like that. That's time to look to get out of the trade. Okay, I like them to react and go. And yeah, you know what? You might get stopped out for break even, and it keeps going down. You could have made, well, that's all nice hindsight. You have to have a trade management plan ahead of time. Okay, so that's really important. One more I want to show you here too. See this red candle? This red candle, like if you're selling here at this 79%, this blue line here, this red candle completely established against the entry. In other words, the open, high, low, and close, or just actually the high and the low, were completely above the entry. That means it's established above it. That's not a good sign. Take the trade off, okay? And again, you had a chance to do that. Okay, so those are some suggestions on what to do if the trade does not go in your favor, and very, very important, because this can result, like if price goes up and hits your stop now, you're sitting in a position where you're out for break even. That's pretty nice. I mean, who knows what's going to happen? I'm just saying that it can make a big difference in your account when you can keep these losses reduced, or even break, you know, non-existent if you go to break even on some of them like this. Okay, so that's what you might want to consider doing when a trade does not go in your favor. So there you go. Again, you know, these are suggestions based on a lot of years of experience, and what you need to do now is decide what will work best for you. Okay, depending on your psychological makeup and your own unique personality profile. Some traders, for example, have no problem with an all or nothing approach, while other traders are more conservative. They want to scale out and they prefer to get some profit out as soon as practical. Like I said, there's no right or wrong, but there are several main mistakes that you can make. First of all, not having a trade management plan at all. That's a big mistake. And second, taking a small profit when you're right, but allowing a full loss when you're wrong. That's a losing formula. Okay. And third, once you decide on a plan, stick with it. Don't manage a trade one way one time and another way the next time and then something else the next time. Be consistent. Okay. So please use whatever you like from these ideas, and I wish you the very best with your trading. Take care.